looking for the accounts payable aging. Now, last time we considered the accounts receivable subsidiary reports, breaking out the accounts receivable by customer, which is possibly more likely to be used for more small businesses, because it's likely that many small businesses are still going to have to deviate from a cash-based system because of the industry that they are in, billing the client and therefore needing to track the accounts receivable and therefore needing a subledger tracking the accounts receivable by who owes them the money. The accounts payable is similar on the payable side of things, but possibly less likely to be happening for small businesses, because oftentimes we will pay things as they become due with small businesses, either with a checking account payment or a credit card payment, which is the area that usually is most affected and most seamlessly integrated and streamlined with the help and use of the bank feeds. Because with the bank feeds, we can just pay off things as they become due, do electronic transfers, and when we pay them off, record them with the bank feed transaction. Even if we don't have the cash, we could still typically do that because we might be paying with a credit card. Hopefully we can pay off the credit card, not dealing with interest payments, but we can still set up the bank feeds with a credit card payment. So why would we have the accounts payable? The accounts payable situation is when we're going to enter the bill into the system before we pay the bill. And often we do that to maximize our cash flow and optimize the time value of money. In other words, inflation happens over time. The longer that we hold on to the money from an inflation standpoint, the better off we are. And from a cash flow standpoint, the longer we hold on to the money, the more cash we have on hand at any given time. Now, for small businesses, this often is not important, because if you have a $75 electric bill or something and you either pay it today or 15 days from today, not a big deal, right? It's not going to affect your whole cash flow strategy for a $75 bill that you either pay today or 15 days from today. But if you're a large company that has larger transactions and or many more transactions, thousands of transactions for $75, and you pay all of those transactions 15 days early when you could have paid them 15 days later, that has an impact. So the bigger the company is, the more cost effective it will be to pay for someone to track the accounts receivable more closely, keeping in consideration time value of money, the game being pay the amount as late as possible while still not incurring a penalty, taking into consideration any cash discounts, and hopefully not pissing off any of the vendors that we're dealing with as we're trying to pay them as late as possible. We want to have a good relationship with our business partners. So that's going to be the idea of it. So similarly with the accounts payable, that means that there's going to be a normal ledger with any account. So if I go into the accounts payable, drilling down on it, we have what we might call a general ledger type of a report. That's what we would call it from a textbook standpoint. Here we're going to call it a transaction report. That's what it's called in QuickBooks, which is breaking out the detail of the information that constructed the accounts payable by date. So then we have the transaction types, which are bills. Bills are the things that we enter into the system in order to increase the accounts payable, remembering that the term bill is possibly the most confusing term, even though it should be like the simplest thing, right? You say it's a bill. Everybody knows what a bill is. Problem is that you could think of a bill that we received from a vendor, which is kind of what we're thinking about here, or you could think of us billing a client, which is what we call an invoice, but you could call it a bill. And sometimes they use the bill terminology when we say we're going to bill the client, right? We're going to bill the client or we're going to invoice the client. Usually when we pay off the bill with a check form or electronic payment expense form, then although we received a bill, we don't enter a bill into QuickBooks. We just pay it off with a cash payment, which would be an expense or check form. So from a data input form standpoint, the bill is only used when you're not paying off the bill when it becomes due, but rather increasing the accounts payable. And then you pay off the bill with a bill payment, which is just basically a form of check or expense type form, one that decreases the checking account but has a specific designation because that gives you information just by knowing the form that the other side decreases cash, other side goes to accounts payable, decreasing the accounts payable rather than paying off like an expense or something like that. So typically then on the subledger, if we're tracking the accounts payable to see when we need to pay them, trying to pay them as late as possible from an internal standpoint, we usually are going to go to the tab to the left and then go to the expenses over here. And then we could go to all of the expenses, and we can sort by the bills and then sort by the open bills, but more likely we'll go to the bills tab and we'll sort by the unpaid bills typically to see which ones are due. We can sort them by due date and try to pay them as late as possible, or possibly we can go into the vendors tab, which represents who we owe the money to, and track the bills for the open bills by vendor. And then of course, when we actually pay them, we can go to the plus button up top and say in the vendors section, we're going to pay the bill, which once again gives us a nice sorting option to see the bills that are due. And then when we pay these bills, if we pay more than one of them, it will make multiple check type forms or expense type forms, bill payment forms, decreasing the checking account for each of those payments. So that's the general process. But we might want the subledger reports, because the subledger reports are going to tie into the balance sheet over here. So most likely, if for external reporting purposes, I want to give an accounts payable report to my supervisor or my client, then I might need it there. Or for external reporting purposes, when we batch together our financial statements, we might need the AP reports. So this is what we would call a subsidiary report from a textbook perspective, because it's going to be organizing the same information that we saw when we drilled down in a general ledger or transaction detail, but give it by vendor rather than by date. So let's go to that first tab and do that. Let's open up the ham boogie, go to the reports on the left-hand side, close up the ham boogie, and then we're going to go down and scroll down who owes you. Now we want to say who you owe, what you owe, they say. So you would assume that if it says what you owe, pretty much all of these reports, just by that name, I would say, well, those are probably going to give me more detail about the accounts payable, because that's what we owe typically. If we owe somebody money, why would we as a business owe somebody money? Could be because we took out a loan, that would be the bank. But from normal day-to-day transactions, it would be because of accounts payable, meaning work was done for us, we incurred expenses, we paid for or did not yet pay for goods and services that we needed in order to generate revenue, and that's going to be the AP. So we've got the accounts payable aging summary, the accounts payable aging detail, mirroring what we saw on the accounts receivable side of things, for the most part, those being the most pure, just subledger reports. We've got the bills and applied payments. We've got the bill payment list. We've got the 1099. Now that's a special report for in the United States if you have to deal with 1099s, because when we pay people in the US, the government, the IRS, has an income tax system. So typically the IRS is, from the IRS's perspective, I just want to lay this out just so we have this in our mind. What does the IRS want from us as a business? Typically they want us to deal with people as employees. Why? Because then they have the most leverage over us to report the employee's income and force us to give them the withholdings, paying the employee's taxes before they even get the money, right? We take it out of their paycheck. But if they can't get an employee-employer situation, then you might have to pay in a contractor situation. So if you pay somebody by contractor and they're a large business, like you pay Edison and they're incorporated or something like that, the IRS is not worried about ratting out Edison, right, to make sure that Edison pays their taxes, because they're already a large corporation. They're not going to hide under the radar. And so therefore the IRS is okay with that. You don't have to do anything special. But if you hire like a contractor, which is not incorporated, maybe they can hide under the radar and not report their income. So the IRS would like to force you to hire them as an employee so that they can make you actually withhold the money from them. But if not, there'll be a contractor, in which case you at least have to rat out to the IRS that you paid them money, because that's revenue to them that the IRS wants to make sure that they get from them as they reported on their income taxes. Okay, that's the general idea there. We'll talk more about that later. Unbilled, unpaid bills. These are the bills that have been entered, which increase accounts payable that have not yet been paid. Therefore, you would think this report would be similar to the accounts receivable detail or aging detail or accounts receivable detail report. And then we have the vendor balance summary and the vendor balance detail. Now, I should have said that these two reports